Good afternoon, everyone, and thank you for joining BDO and Make UK's Q4 Manufacturing Outlook webinar today. I'm Richard Austin, head of BDO's manufacturing sector. Welcome to you all. Just a little kind of recap in terms of what we've seen this year. Now we're heading towards the holiday season. The first couple of quarters that we saw this year showed quite a strong footing for manufacturing. Q3 was an interesting one. There were some interesting numbers coming out of that, which looked to see that manufacturing was taking a bit of a step back. However, as we'll go through this afternoon, this quarter's report, which was launched yesterday, finds that the sector is ending up on a positive note before year end. So today we're delighted to be joined by Make UK Senior Economist James Brougham, who will take us through the manufacturing update, some of the numbers and some of the insights as well. Adding to that in terms of insights, obviously we've had the autumn statement that came out a few weeks ago, and we're delighted to be joined by a couple of our colleagues from BDO. So we have a couple of tax experts joining us. We have Steve Watts and Eyad Hamouieh, who will be pontificating on the world of the outcomes of the autumn statement. Steve is an expert in capital allowances, so he's very much the right person to talk to in terms of capital allowance announcements that have come out and the extension around that. So he'll be sharing his thoughts around that. And then we'll be followed by Eyad as well, who's a partner and head of our R&D in the London region for BDO. And he'll be talking to us about R&D tax reliefs and some of the experience he's had and his background in engineering businesses will come to play in that as well. So some interesting conversations, hopefully based on one, the Q4 results, but also broader thoughts around the autumn statement. As always, we'll open up the forum for a live Q&A at the end. So if you have any questions at all, please do add the questions to the online button, which I think should be at the bottom of your screen. But without further ado, I will hand over to James to give us the results of Q4. Over to you, James.
Thank you very much, Richard, and good afternoon, everyone. This quarter, final quarter in the year, is an interesting one, not for the least, as you'll have a rare admission, I must say, by my own saying that perhaps we in Q3, as economists and effectively the pundits of the industry, doubted expectations that were set in the third quarter, particularly around output, which actually we've been shown to be off the mark, and actually the sector outperformed these expectations in this quarter, rather surprisingly, and indeed without too much fanfare or obvious drivers to why this might be occurring. As such, we think a lot of this is a blip, as we've seen throughout earlier in the year, a blip with sudden supply chain easements in certain sectors, allowing for a lot of output to be generated in a quarter where it wasn't necessarily expected in the quarter prior. So if we start with the next slide, please, I'll go for a quick overview and then we'll interrogate some of the metrics and pull out some interesting findings. But I think the first point that I just made then is that output bounced back really after a very, very flat quarter. I would be hesitant to suggest that this is the start of an upward trajectory into next year. But then again, as we said in the third quarter, given the current fundamentals of the economy, what I really mean by that is quite simply, I mean the elevated base rate driving down economic activity in all sectors, but as well specifically the manufacturing sector. We don't see that easing by next quarter, and as such, we don't really see the conditions for that bounce back or that continued expansion in output production to continue into next quarter. One interesting thing to observe, though, is that despite output growing, orders did not grow to follow suit. So that adds a little bit more evidence to that thought that this is an easement in supply chains and an easement in unlocking value that was set in warehouses, but actually the demand for goods within the sector hasn't changed much between much quarter, and that is at that relatively flat level. A small sideshow is that export orders have exceeded slightly domestic market orders. This is the first time since the pandemic, but given this is only a 1 quarter movement of this action, I would hesitate to draw long-term conclusions about what this might mean, particularly given that we'll often be invited to conclude what this might mean for our relationship with the EU, given that approximately 65–66% of all manufactured goods trade is with the bloc. What's, I suppose, a bittersweet moment for the sector is we see that in pricing. So depends whether you're a customer or supplier, really, but the rate of price setting activity continues to come down. It still remains expansionary, but the rate at which, or the proportion of the sector which indicates that it's rising its prices on a quarter-to-quarter basis is coming down, and margins forever, as they have been now for about best part of a year, forever just in negativity, but give indication there will be an expansion territory in aggregate by next quarter. Following a hiring freeze that was seen in our data last quarter, labour growth comes back a little, not to the same levels that we saw in the first and second quarter, but it seems that hiring freeze is over, and indeed it seems that nervousness, that severe nervousness that occurred in the third quarter last year has eased somewhat as we move into the start of next year. Despite all of this, confidence remains rather steady, which is interesting and also sometimes a little surprising, but gives a little indication as to the effects we're seeing are very likely to be short-term effects within the quarterly data, given that the confidence doesn't seem too much change. Now, I'll talk about a bit more about that when we get to the relevant slide. But we can see we have some rather uninteresting forecasts here, particularly for 2024. Now, 2023 we knew was going to be a rather flat year, and some might argue that actually it's quite a success, given, as you might remember, we started the year, whether we're talking about the wider UK economy in that penultimate bullet point or just the manufacturing segment of it, that we were going into that low and slow recession. So to finish up the year with just under 1% growth, certainly not fantastic, but better than perhaps I think a lot of us thought it would be turning into the year at about this time last year. What's more interesting is 2024. Interesting is perhaps the wrong word. Disappointing is probably the more accurate one. It's looking to be rather flat and rather anemic. We don't have much to say for the downside, but indeed we don't have much to say for the upside. So what I mean by that is that this is driven largely by the expectation of base rates will remain elevated, and they might come down perhaps for them, but around the current premonition is around April time, but they'll come down very slowly, and the effects for the wider economy to kick back into gear and economic activity to resume will be commensurately slow as well as those base rates come down. So that's driving why the forecasts are so flat for the year. So we can have the next forecast, please. Next slide, please. So this is output and orders. And if we just draw attention to the right-hand side, this shows the balance of changes. I always say on these things, please do not interpret these bars to mean absolute quantities of change. What they represent is the proportion, effectively the balance of proportion of the sector that is reported either an increase in output or a decrease. So if we look on the far right here under the 2023 Q4, this is the latest data. You can see what I was alluding to at the start there. If you look at 2023 Q3, where the bars are very, very flat, almost the yellow bar just underneath in the negative line. We come here now into into Q4, and you see output has bounced back far beyond our expectation, which was for the red bar to remain effectively close to zero again. But orders have not come up to match. So this shows a lot around that value being unlocked, but the demand conditions within the sector haven't really fundamentally changed that much from last quarter, as those demand for goods fails to drive. The demand in the sector fails to drive orders up in the sector. This is likely to continue into the next quarter, and this is also some degree of the destocking we've seen recently in the past couple of quarters, especially compared to the first 2 quarters of the year, where you might remember perhaps at the the final quarter of last year, we were in a situation where stockpiling was almost at an all-time high, mostly due to supply chain frictions, meaning lead times were exceptionally high within the industry, which was limiting businesses' ability to do business, to get the finished product to customers. So what businesses did as a result was they stockpiled at sort of extraordinary levels. But now, as we persisted in this high interest rate environment, that relative cost of holding that capital and holding warehouses of, let's say, £1 million, £2 million, not working for you as capital, has become untenably costly. And so businesses have destocked significantly, which is also driving, and continue to do so, which is driving the fall in orders as businesses work through their stocks and not necessarily order up at the same levels they have been over the past sort of two to three quarters prior. If we have the next slide, please. So that balance between orders and export orders and domestic orders, as I mentioned at the start. Now, if you look at the far right, you can actually see, and it's just the left of the green box bar. The green box bar, wherever you see that, indicates manufacturers' future expectation. That is not our forecast. That is directly taken from the aggregate data when the sector is asked, what do you think is going to happen with regards to your, whatever it might be, but in this case, UK orders and export orders in the next quarter. So that would be Q1 of next year. But if we look just to the left, that's the latest data, today's data, 2023 Q4. You can see that UK orders have become remotely flat. And actually what's driving the net order increase this quarter is export orders. Now, if you glimpse back over the previous couple of columns, you'll see that typically the UK orders has led export orders pretty much since middle of 2020, something like that. So while it is important to make note that that has occurred, until we see that sustain, I would very much so hazard against drawing to conclusions around what this might mean about trade flows and our trading relationship with the European Union, because of course that is fundamentally what we are looking at here, given that the overwhelming majority of net trade from the manufacturing sector in the UK is with the European Union. And so that is the key driver of the export orders metric that we see here. Next slide, please. Now, this shows, as I sort of made a small joke about at the start, the relationship between what manufacturers expected to happen with regards to outputs and orders and what actually occurred. And I know it's quite confusing, but I'll explain it so it makes sense. Again, as usual, let's look at the far right bar. Okay, and now if we look at these, you can see there are two bars. One is dark red, which is output, and one is orange, which is orders. Now, that is what the sector expected to post this quarter. So those are the expectations that were set in the third quarter, i.e. last quarter, for Q4 performance. The dots are what the data has actually come in as from the sector. So we use this as a sense check, and also we use this as a way to see, have any sudden shocks to the manufacturing sector in the UK occurred within 3 months, within 3 months that have upset those expectations. Now, obviously, to give contrast, you can look around the middle of the chart, you can see 2020 Q3 around COVID. This is the kind of effect we'd expect, the unexpected collapse of the economy following COVID. Now, if we return our attention back to the far right, you can see that actually the little red dot was pretty much bang on output. Orders did not actually come to anywhere near that expectation, but output was pretty much spot on what the sector expected. Indeed, I made hint to this at the start when I said that we were certainly expecting output to not return to the levels it has done for this quarter. We do expect this to be a short-term flash related to supply chain incidents and value being unlocked, given that orders, which is the little black-blue dot as you see on the right, has not come up to meet those expectations that we always thought in the third quarter, that manufacturers in aggregate, the data had suggested that the sector was overly optimistic about its orders performance going into the end of the year. Next slide, please. Margins and prices and margins even. But this has been one of the major sideshows of this work for perhaps two and a half years now. And I think you can probably see why. If you look on generally the second half of the chart here, you can see there's a mountain of red and orange bars. And this has been the price inflation, effectively witnessing the driver of the price inflation experienced by the industry over that same period of time. But of course, what we're looking at here is not producer price inflation. What we're looking at here is manufacturers' price setting behavior. And so the red bars represent the UK prices, and or the orange bars represent export prices, and the lines, both light blue and dark blue, represent margins. Now, we can see just to the left of the green box bar that price setting behavior by the sector has come down. It's still within expansionary territory in terms of the balance of change figure, but it's come a ways off those record-breaking levels that we saw in the crest of that mountain there, which actually is a fun fact. This data set only shows here about 7 or 8 years, but this data in its form goes back 30 years. And actually where you can see that red bar at around 22 Q1 peaking the parapet there, that was the highest ever figure recorded for price setting behavior in Manufacturing Outlook's 30-year history. So we can see it's come down somewhat. It still remains expansionary, and indeed for a little litmus test, you can see that even over to the left-hand side of the graph, despite me saying it's coming down, you can see on those index levels on balance change figures, it's actually a little still higher than that 5-year average prior to it. Margins is what's been really interesting here, because it had been expected that price setting behavior would remain high from around the first quarter of the year. Instead, it's come down faster than expected. But what that has also meant is that it's taken away the breathing room from the sector in order to recoup its margins at the rate on aggregate it would like to see. And so that's why we can see these lines for the past 3 or 4 quarters sort of hanging just below the zero line. Pretty much every previous quarter consecutively, the margins expectation has been effectively the green box then has been for margins to come up into positivity. And time again, that hasn't happened because price setting behavior has cooled faster than expected. And we're very likely to see that again here. So you see here in the green box, that is the expected price setting behavior for the first quarter of the year next year. And we're unlikely to see that if recent history is anything to go by. Each consecutive quarter, that has been the expectation as industry that, oh, actually price setting behavior is going to come up compared to what it once was. It doesn't, it actually comes slightly down. And as a result, you can see that expectation for margins to come above on aggregate to come into positivity. That breathing room will be removed around the ability for the sector to raise those prices. And then margins will remain most likely in limbo again, repeating this behavior that we've seen for the previous quarters with the 2 lines just skirting underneath the zero line. Next slide, please. But in optimism, and this is something to frame everything in, and indeed, even after over the past couple of quarters, when we've had particularly flat results in the third quarter of the year, confidence, the confidence metric as measured by business performance confidence, so that's an aggregate of the sector's view of their own businesses, and confidence in the wider UK economy as measured by the orange line, seem robustly unfussed by these short-term movements. So what does that tell us? I think the leading thing that tells us is that this is exactly what they are, short-term movements. Now, when we have major long-term systemic changes that are coming into sectors, let's say COVID, let's say the energy crisis, you can see quite obviously here on the graph where those things have taken a serious dink into confidence, whether it be in the 2019 period, in the 2020 Q2 period, or most recently coming when it is trending down from about 21 down into 22 Q3. But since then, it's almost, you get your ruler out, it almost looks like 2 parallel lines. This is, even though there's no change in confidence really going up or going down, this is a good indication that the variability, or indeed the negative variability that we're seeing in the data at the minute, will remain short term, and there isn't a systemic threat given these movements that we're seeing in the latest data, and indeed the Q3 data as well. It's important to note as well that this is a diffusion index, so it's just a fancy word really for saying if it's above the 5 line, if you look on the left, it means it's positive, and if it's below the 5 line, it's negative. So it remains in positive territory, it remains unchanged roundly, unbothered is a better word perhaps, compared to the previous quarter, and remains in a good position even where perhaps some other metrics may not be so positive. So next slide, please. So the final set of metrics we'll talk about, employment and investment. Now, I hinted at the start that we had effectively what was a hiring freeze on aggregate in the sector. When you look at the 23 Q3 bar, so that's the 3rd bar from the right, including the green box bar, you can see you can barely see the red slither. Previously in the first 2 quarters, we'd had fairly robust reported employment growth from the sector, which is the red bars. And then the green box bar, this always in this particular case, despite it acting in the same fashion as the other green box bars, i.e. the future intention of employment in the next 3 months, what this really proxies is that intention to employ. We're very unlikely to see that kind of balance figure rendered. There's more proxies with perhaps the vacancies data that we see in the sector, that long-term demand for labour within the UK's manufacturing sector is far outpacing the country's ability to supply it. And I think always an interesting data point we raise as part of this conversation is that vacancies rate. It's around the 69,000 mark, down from last quarter where it was around 70,000. That data is rounded to 1,000, so it's probably more nuanced than that, but that's the best that comes out of the national statistics. But as a ratio, what's more interesting is understanding that per 100 jobs employed, currently there are 2.9 vacant. Now on its own, that might not mean much or anything, but at the height of the recovery period, it was about sort of July 2 years ago. It peaked again July last year as well. It was about 4 jobs per 100 employed. Now, the long run average of this data, it goes back 30 years pre-COVID. The long run average is 2, pretty much flat. 2 jobs vacant per 100 employed in the sector. So still to this day, and I said it's 2.9, so let's say for easy maths 3, effectively the demand for labor in the industry is 50% higher than that long run 20-year average. And it doesn't seem to be going away particularly fast. So it's almost that new normal for the sector, that there is a embedded now long-term shortage, as proxied or illustrated perhaps by the live vacancy rate in the sector being sustained for so long at this new level. So despite that, you can still have these short-term employment movements, such as the hiring freeze. It does not negate the concept that the sector, in terms of limited value and amount of vacancies available, still remains at a long-term high. But we see in the latest data, Q4, that the red bar pops up a little bit compared to the last quarter, which is a signal about the easing compared to the perhaps more nervous position as illustrated by other metrics that we had in the last quarter. Finally, on investment intentions, that's the orange line. Not too much to say here because they're such small movements. So you know, in the last quarter, and these are 12-month investment intentions. So this takes the litmus test at the moment in time about what the future investment intention is for a given manufacturer over the coming 12 months, not just the next quarter. And we can see in the last quarter it pipped up, and now it pipped down, having pipped up in Q1 as well. It's at a rather uninteresting level, but I suppose what's good is it remains roundly positive. This is typical of a holding pattern. We know from other sources as well, and the wider mood in the manufacturing economy, there is significant appetite to invest, and we're seeing a lot of what's driving a lot of this positive intention at the moment is still bleeding through from those energy efficiency investments that almost all manufacturers are working towards, perhaps chiefly driven initially by the energy crisis, but now stand for benefit in the long term from having made those perhaps under duress in the past year and a half or so. Next slide, please. Now, this is just a visualization of those initial forecasts I talked about. We'll just breeze over this because we'll go back to the final slide, please. So this is exact same as the first slide. I know I've covered a lot here, and as I always do, I think it's best to just leave you with two things to take away. And I think number one is that the price setting behavior is likely to continue to cool, which is good for the wider economy, good for the Bank of England, good for meeting our inflation targets. However, what this means for the sector is that the room for margins recovery is being removed in the same period. So depending on where you sit in the value chain, that is something to consider moving forward. And that looks set to continue really right the way throughout the year. And then the second point, unfortunately not the rosiest point, but the forecast, given all of what we've discussed, the overwhelming business environment, pretty much vis-a-vis the base rate and the effects on the wider economy, means that the 2024 forecast is quite flat, if not exactly flat. 2024, 0.1% for the manufacturing sector. So very little growth expected, but that's not to be said that the headline numbers aren't everything, because a lot happens in the meantime. And what I'm talking about that is around investment, energy efficiency investments, and still transformative business practice that can and will set up the UK's manufacturing sector into be a better position when it tackles what seems like quite a far away now at 2025. Just before I finish up here, it'd be remiss not to give a quick mention for a couple of minutes, of course, what we saw in the autumn statement and what that means to Make UK. And we've been long campaigning for many of these things. And I think as we come towards perhaps what might be a general election year, looking likely to be, we've had a significant moment, things of benefit for the sector. And I know a colleague from BDO, Steve, is going to talk more about this, but I just wanted to make note of some of those changes, whether it be the permanency of full expensing, the acknowledgement, the final acknowledgement of reviews to the apprentice levy, I suppose a little bit short of committed change, but that is something that Make UK have been banging on the door of government for perhaps just over a decade, as it has not been fit for purposes, not been serving the sector well. And then on investment zones, doubling that period of incentive from 5 years to 10 years. So all of this together means that we might be looking at a government or government policy that is finally taking a bit more of a long-term approach towards the manufacturing sector, something it's been clamoring for so long. Now, while we are short of our headline ask, which is the industrial strategy, we do have the conciliation of an advanced manufacturing plan. This is not sufficient to be an industrial strategy, I think, if I speak candidly. It does not give the long-term confidence to the sector that it so demands, but it's certainly a step in the right direction. And it's something that I must say that with these measures announced in the autumn statement, it means that the sector is perhaps back at the table on the conversation within the halls of Whitehall. And indeed, when it comes time to campaigning from opposition and indeed the incumbents, it means that the sector is far likely to get a look in on that policy discussion on benefits, long-term benefits for the sector, than perhaps it would have done had we had an election, let's say, a year ago. So thank you for that, and I will hand you back to Richard.
Thank you, James. That's our whistle-stop tour of the results from Q4. I think things that stand out for me is it seems like things are stabilizing. Growth will be flat, or is expected to be flat next year, but it does raise the question of investment as well around longer term views, increasing efficiency, etc. if growth is expected to be relatively flat. And clearly some of the comments and outcomes of the autumn statement have played to that agenda, just as James was saying. So it's interesting to see that the investment intentions on those charts have dipped slightly, but really those results were picked up prior to the autumn statement being announced. So I think the next quarter could be quite an interesting viewpoint to see if manufacturers are actually taking that on board and looking to take advantage of that. With that, clearly it's a recognised uptick in terms of recognition within Whitehall, as James said. Next year is going to be an interesting one politically. I mean, it's always an interesting one. Even this week's interesting. But I think the future and the positioning of manufacturing, James is absolutely right, is moving to the forefront of the agenda for the British economy. Just in terms of introducing people, I sort of spoke about Steve and Eyad. So Steve, it will be kicking in a second. He's a tax partner, one of our tax partners at BDO, but he's going to provide a slightly more in-depth understanding on capital allowances. He's one of our experts around that and will provide some insights and some commentary around that, specifically around the manufacturing side. And as I said previously, then we'll have Eyad Hamouieh, who will be talking about R&D updates and some of the changes within the autumn statement around that. So with that, I will hand over to Steve. Steve.
Thank you, Richard. Good afternoon, everyone. Yes, today I'm going to provide a brief overview of the capital allowance related announcements in the autumn statement in November and relevance to the manufacturing sector. So next slide, please. So I'm going to briefly just sort of cover three main areas today, just sort of commenting on full expensing, sort of updates on the investment zones and free ports that were announced, and also there's a couple of consultations that were announced in the autumn statement as well, which I just wanted to draw some attention to today. So firstly, on full expensing, this was something that was introduced in the spring budget earlier this year, when the Chancellor announced full expensing as a successor to the 130% super deduction that had previously been introduced by his predecessor to boost business investment sort of post-COVID and before the change in the rate of corporation tax. Full expensing was initially introduced for a period of 3 years up until the end of March 26. And at the time of the initial announcement, the intention was to make it permanent once economic circumstances allowed. So I think with the changes in the economy over the last sort of 6-9 months, the Chancellor suggested that the timing was now right to make full expensing permanent. And this was described as the largest business tax cut in modern history, and providing the most generous capital allowances in the G7 economy. So it's a great opportunity for investment to take place. The OBR have estimated the measure will increase investment by around £3 billion a year. So it'll be interesting to see if there's any movement in those charts, which James shared with us earlier going forward. So just as a reminder, what do we mean by full expensing? Well, this is a first-year allowance to encourage investment in plant and machinery, and applies to all companies subject to corporation tax. Providing full expensing falls into two categories. So there's 100% first-year allowance for any expenditure on what's known as main pool plant and machinery. So for every £100,000 invested, there's a tax deduction available of £25,000 in the year of expenditure, rather than being available at the normal writing down allowance rates of 18% on a reducing balance basis. And also 50% first-year allowance for any expenditure on special rate pool plant and machinery. So it's typically a longer life type assets, i.e. long life assets or integral features of a building or structure, which would normally be written down at just 6%. The balance of the other 50% of any 50% first-year allowance goes into the normal 6% rate. There are exclusions, particularly around any plant and machinery provided for leasing and cars, etc. And so obviously there's a need to track any expenditure that is eligible for full expensing, because it's doesn't form part of the normal main pools. And there can be a balancing charge on any future disposal of any assets that have been eligible for the 100% first-year allowances. It's very early days, obviously, with full expensing only came in from 1st of April, expenditure from 1st of April this year, so we've not really seen much action from HMRC in terms of their approach on full expensing. But what we have seen is some activity in terms of the predecessor around superdeduction claims for allowances, and HMRC have been sort of taking a fairly hard line in terms of where they have looked at this in detail. So we've seen a number of nudge letters coming from HMRC suggesting that clients should check their claims where they've been making claims for superdeduction to make sure they're within the rules in advance of any inquiry that they may raise. And secondly, in terms of detailed inquiries that we've seen coming from HMRC, very detailed approach, looking for a lot of supporting information and records in terms of purchase orders, contract dates for superdeduction and dates of expenditure of when items were incurred. So it's important that where any of these claims are being made, that a detailed review and approach is taken to ensure that matters are supported in the event of any HMRC inquiry. So really, real positive here in terms of making the move permanent. We were involved in consultations with HMRC and HM Treasury around the successor to superdeduction, and one of the things which our clients really asked us to stress with that was having a bit more certainty and permanence in any regime to encourage investment. The superdeduction obviously providing a better rate of first-year allowance, but with it only coming in for 2 years and at very short notice, didn't really allow businesses time to invest. So I think the main thing coming out with the permanence of full expensing really does allow a bit more time to plan those investments. Moving on to investment zones and free ports. James mentioned earlier, these tax breaks for investment zones were extended from 5 years to 10 years. So the Freeport's relief were due to expire at the end of September 26, and now the deadline for that for any Freeports in England has been moved out to September 2031. And the investment zones that have been announced, any sort of expenditure in tax sites originally due to be for just 5 years is now being extended to a period of 10 years, again providing certainty for any investment in these zones. There are a number of tax incentives that apply for tax sites within either of these zones, including stamp duty, land tax, business rates, and lower national insurance contributions. But on the capital allowances side, there is a 100% allowance for any expenditure on plant and machinery. So that's all plant and machinery, and a 10% allowance for structures and buildings rather than the normal 3% write-down rate. So there's good opportunities for investment in terms of these identified sites as and when they get released. And there's confirmation on advanced manufacturing investments zones are being announced for Greater Manchester and East and West Midlands areas as well. A couple of things that may have gone unnoticed in terms of the autumn statement was around a couple of consultations and working groups that have been set up. As I mentioned earlier, full expensing does exclude plant and machinery provided for leasing. So there's going to be a working group that's been set up by HMRC and HM Treasury to review the existing exclusion of leasing from first year allowance and look at a solution to support the leasing industry, taking advantage of full expensing and also ways of managing risks of abuse and error. So this is very early stages, but we expect to see a consultation coming from this maybe next year or the year after. And also technical consultation on some potential wider changes to plant machinery was also announced. This is really looking at simplification, but not substantive reform, and is just purely to be focused on plant and machinery allowances and not any of the other forms of allowances, such as structures and buildings allowances or research and development allowances. It's not going to have any impact on the full expensing that was announced, but if there are any measures for simplifying some of the rules as a result of full expensing, that's going to be the focus. And meetings will start to happen from early part of next year, with intention of draft legislation perhaps coming out in the summer. So we'll be very much involved in this process and be happy to provide any details of future updates. So just in summary, obviously, I think that the key thing here is the greater certainty for businesses to plan longer term investment in terms of both full expensing and in terms of investment zones. And also, I think again, one of the things that James mentioned, I think there's also should be seen as support for companies looking to decarbonise, perhaps investing in newer green plant machinery, to think about the full expensing that could be available and assist in that process. So I'm now going to hand over to Eyad, who's going to provide an update on R&D.
Thank you, Steve. All right, so as Steve said and Richard introduced me, my name is Eyad. I head up the London R&D team. I've been involved in R&D for maybe I think more than 14 years. But before that, I used to be an engineer. I used to design integrated circuits back then, before I moved on to the R&D side. So what I want to go through today is just basically some of the changes that are happening within the R&D tax relief, kind of with the ultimate kind of changes in the last autumn statement. But I want to take you on that journey to kind of set the scene. So Bal, if you don't mind moving on to the next slide. So I want to start off with the R&D tax relief statistics are released every September for the previous tax year. So just bear that in mind in the context of what I will be talking about as we go along. I'm not going to go into hopefully what is R&D tax. Hopefully everyone on this call is already aware of that. So let's dive right in. So these are the numbers released in September, showing an increase across the number of claimants, the amount of expenditure, and the benefits that each business that claims gets as of FY22. You can see the average expenditure for every business is nearly £500,000, and the average benefit based on these numbers is around £85,000. So that's overall in terms of all businesses are claiming R&D tax relief. Well, if we kind of focus a bit more on the manufacturing and industrials sector, we can see that actually nearly a quarter of that R&D spend happens in the sector, and roughly between a quarter to a fifth of the benefit actually comes to that sector as well. And nearly 20, a quarter of that as well in terms of claims. The average benefit, for those of you who are doing a bit of quick math, per claim is nearly just north of £80,000. And if we dig in a bit deeper as well, and we look at the split between the SME businesses and the RDEC, or the large businesses or businesses claiming under the large rules, you can see the benefit is split equally, but the number of claims going under each is significantly different, meaning the average claim or the tax relief benefit for an SME is nearly 50,000, but a large business is claiming nearly 250,000 for every submission it does, despite the fact that for that period the relief rates were still higher for SMEs compared to large businesses. Next slide, please, Val. So what happened so far? So there have been a lot of changes in the R&D tax regime, and maybe kind of really spurred by some of what we read in the news kind of back in 2021. There's an article about nearly north of £300 million worth of actual benefit that was allocated to fraud or error. Some advisors who actually were claiming incorrectly or misclaiming. And most recently in 2022, that number was around 1.1 billion. And that wasn't actually the full number. It was extrapolated based on an assessment on 500 claims. So the level of accuracy may be doubted, but you can see the significant amount that HMRC is saying is actually incorrect or fraudulent in terms of the quantum that's being given out. So HMRC and the Chancellor and the Treasurer, I think, kind of set out to try to minimize that fraud by introducing a whole host of measures starting from last year in the previous budget. So initially, there was a cap on the amount of R&D tax credit that was being paid to SMEs. That's still in place for periods starting on or after the 1st of April 2021. That tax credit limit is £20,000 plus 300% of the PAYE and NIC. There are some exceptions, but I won't go into that level of detail for now. Another change was the R&D rates. So the SME rates dropped in that period from the 1st of April 2023. And for SMEs, that was a significant change. So the benefit used to be for an SME kind of up to 33p for every £1 that was spent. Now it's a range from 18p to 21.5p for every pound that was spent. Right, so there's significant change in terms of the amount that is now available for SMEs, and obviously you can see there's a big push on the SMEs where there's a view that that's where some of the errors and fraudulent claims are being submitted. On the flip side, for large businesses, that rate has gone up in that period, right? So the RDEC rate for businesses or companies claiming under large company rules went up to 20%, meaning actually from 10.5 post-tax to anything from 14.7 to 16.2 for large businesses. Now, I'm not talking here about and I won't go into, at this point in time, the intense R&D SME businesses. I'll come to that a bit later in the slides. Next, Mel. So you can also see here that there was some inclusion of additional costs. We have a lot of clients that we work with where they may host some of their development work or some of their activities on something like Microsoft Azure or Amazon web hosting services. Those used to be used not qualify. Now they've been allowed. Data costs are allowed. Pure mathematics is also now an allowable and eligible area of science and technology. So there were these additions from the 1st of April 2023. Next, Bow. There's also this request around pre-notification. Now that is quite interesting. Now, not a lot of businesses will have had to kind of go through this process as of yet, because it's for accounting periods on or after the 1st of April. Essentially, and hopefully a lot of businesses that are already claiming will continue to claim. But essentially, if you're a new business hasn't claimed before, there is a requirement to notify HMRC that you are going to be putting a claim through. On top of that, businesses that have claimed before, there's a certain time frame that they need to make sure that they put in a claim. Otherwise, they will need to go through the process of notification. The last change in the previous autumn was the additional information form. Now, that was maybe the biggest change that was introduced in the previous budget. There's a whole host of new methodologies of actually how you submit your R&D claim for any submission post the 8th of August. That doesn't matter when the accounting period is, as long as post that date, then the business or the advisor needs to follow a preset digital kind of platform to input the data. There's additional information like naming this individual who is within the business, who is a senior officer responsible looking after the R&D from the business. You need to actually also put in the name of who the advisor is. Is it is it an accountancy firm? Is it a specialist boutique? And including other areas like number of projects they need to be described, how the costs are broken down. There's a certain method that now needs to be uniform in terms of the submission of these R&D claims. And there's a lot of still learning that we can see happening in other organizations that are trying to submit through this process. So these are the changes that have been happening or have already been announced. Val, next slide, please. Now, what have we seen in the market up until today? There's been a significant number of increase in inquiries. So we have a lot of businesses approach us, asking us to help with questions from HMRC. Whether a payment has been made or not doesn't mean a business is safe. I had a business yesterday call me up. They've submitted an R&D claim. They've already paid out the benefits, but unfortunately, HMRC has come back and challenged that. And that is a situation where we may not be able to help because I think the R&D activities may fall short of that definition. On the flip side, we've had situations where we've been approached to help with R&D inquiry and we've been managed to help through that process. But actually what we've seen is a significant increase in that. Next, Val. We've also seen, and that was maybe whether direct or indirect factor, but there's been an increase in number of individuals within HMRC who are working on the R&D compliance side, whether they're compliance officers or just tax inspectors. But there's been some documentation saying that they've hired as many as 600 additional staff for that sector to try to tackle the fraudulent and error claims. But what have we seen from that? We've been seeing that there's some individuals who unfortunately still undergoing the training to kind of the full understanding of what the legislation and the current on R&D tax relief is saying. But also we've seen situations where there hasn't been an allocated inspector of taxes as of yet for a letter or an inquiry that's already been sent out to a client, which isn't usually what we'd see. We'd usually see an inspector looking at an R&D claim, assessing it, and then sending an email out asking for further questions. We're now seeing the opposite. Questions are being asked, and then when we contact HMRC to help that business, we're told that no inspector is yet allocated to that job. So this kind of gives you an idea of the level of push or scrutiny or procedures that are going through from an HMRC point of view to try to tackle those issues. Next, Bow. And we've seen actually significant increase from HMRC's documentation and communication of incorrect submissions, especially with the introduction of the AIF forms. Within the first month only since the introduction of the AIF forms, so that's from 8th of August till the 5th of September, HMRC said that around 1,000 out of 2,000 submissions were actually incorrect. And that's in the first month. So you can imagine if you're within that kind of time period where you have a limited time to resubmit an R&D claim, you're pushing that deadline, those businesses may have missed out or not been able to claim because of these new AIF rules. Next, Bal, please. So what's coming? The biggest announcement in the autumn statement is actually the merged scheme. So essentially, the combination of, or the no longer separation between what is an SME scheme and what is a RDEC or large company scheme. Actually, this is consistent with some other jurisdictions like Ireland and France, to name only a few, where there's only one R&D regime that businesses can claim for. The benefit for SMEs in this situation is actually the R&D income or benefit is accounted above the line. So actually seen as an income, which actually may help in some situations from a valuation or EBITDA point of view. Although we've had situations or conversations where some of that valuation was not taken into account if there wasn't a verified advisor or a consistent claim happening over the last or several years. But actually it just does provide that above the line income for SMEs from a valuation point of view. But being above the line means it's taxed. So that tax could go anything from 19% to 25%. And for loss-making businesses who are not paying tax, the rate of 19% is calculated. With this merge scheme, the biggest element of it is the subcontracted elements. Now, the subcontracted element has two facets to it. There is actually one side of large businesses now can claim for subcontracting costs. So previously, large companies could only claim for a small proportion of subcontracted costs, such as qualifying bodies or individuals, etc. But now they can claim for subcontracting third parties. On the flip side, that means SMEs are being subcontracted by large companies now could potentially lose the ability to claim. And this is where the flip side of the subcontracted rule comes, because HMRC wants to make sure that only one party in a subcontracted arrangement can claim. There's a lot more detail still to be digested on that, but essentially the party that is intending to carry out the R&D is a party that can currently claim. I'm sure more details will come out around that. But this also removes the element of subsidy. So one of the things that have been removed. So even if a business receives a grant, whether it's notified state aid or not notified state aid, or if it's been subsidized by another third party, that no longer has an impact on whether they can claim, or if they can claim under large company rules or SME rules, they can claim regardless. The other major change is overseas costs. So a lot of businesses may be subcontracting out some of the work overseas. We have some of our clients who are in the manufacturing space that may subcontract out to Europe, some subcontract out further out to Asia. All those costs are no longer allowable, whether they are related to R&D or not. There are some small exceptions, but the general rule is overseas costs are no longer allowable. This is again consistent with some of the other jurisdictions around the world where R&D has to take place in that jurisdiction. The other point is in terms of the merged scheme now allows businesses to claim 20%, right? So the headline rate for both large companies and SMEs is now 20%. That means businesses can now claim anything from 14.7% of their R&D spend up to 16.2% of what they spend net of tax, right? So depending on their tax position. And again, this is notwithstanding the intense R&D regime. But that's the kind of the changes you can see may have a bit of a squeezing impact on SMEs, but actually a beneficial impact on the large companies. And I'm sure there'll be more detail to follow. We are in conversation with HMRC for some of that detail, especially around that subcontracted arrangement point and which party can claim in a subcontracted relationship. Next, Val, please. The last of those changes is the intense R&D regime. It's a parallel regime with the merged R&D regime. Now, this is for SMEs that was introduced on the 1st of April 2023. Right now, it used to be that you had to have spend of 40% on R&D as compared to your total spend in a year. This has now been reduced to 30% from the 1st of April 2024. But actually, it does give a rate that is closer to the rate that we used to have for SMEs beforehand, which is essentially for every £1 spent, around 27p is handed back on that R&D benefit. But those are the major changes that we've seen in the latest autumn statement. like I said, a lot of changes. And in summary, these changes are with an aim to simplify. There's a question about how much of that simplification, if you still have those two parallel regimes, how much of that simplification is with some of the subcontracted rules, but it's also to tackle some of the fraud and the error that HMRC has seen over the last few years. That's my part. I'm happy to kind of hand back to Richard and the team for any Q&A.
Brilliant. Thank you, everyone. Really interesting updates. We have had several questions that have come through. So if I just run through those. James, the first question is for you. So what is your opinion on the outlook for food inflation over the next 6 to 12 months?
It's an interesting question because, of course, food, if I'm collecting properly, has outpaced baseline, CPI inflation for some time. I think when I looked at the latest CPI figures, it's falling back in line with the overall CPI. It was, really elevated throughout most of this year. Food's always a tricky one as well. I'll keep it short. I can talk about this all day, but food's always a tricky one, of course, because it's not really a normal commodity, and some would argue that we all pay in the UK less than we should, just due to the the extreme competition between the big supermarkets. I think, in short, for next year, I expect it to continue, because I mean, for most of the year it's been falling back in line. I don't have any major things on the horizon that would make me think that it's not going to continue to fall back in line with overall CPI headline rate. Maybe it'll come to rest a little bit above it, but I don't foresee any particular shocks again like we've seen over the past year, where it's come back up. But of course, that doesn't change. It is just inflation, so it doesn't change the index values of food, which will be significantly higher, as we've all been to the supermarket and seen. It'll be a long time. It's not going to go back to where it was. I just think the rate of change will fall back in line with overall inflation, which is, of course, if the Bank of England's got anything to say about it, will continue to come down steadily towards that target.
Okay, thank you, James. And the next question again for yourself. Do you think if the government returned to its policy of low corporation income tax rates, it would create a boost for UK manufacturing?
Yeah, that's always an argument. It's always an argument we have both in our office and as economists in sort of the sector, for not just the manufacturing sector, any sector really. It's a tricky one, and I won't directly answer it, but I'll answer it by saying it would something that would be a long term. So if you make those changes, you might generate a quick news story as a major manufacturer and a major employer in a given region, a household name, makes a move based on these announcements, or threatens to move not based on one of these announcements. For the wider makeup of the UK manufacturing economy, the benefits of these things will be meted out over a 5-year, 10-year period. And in that period, it would be unfair to sort of assess corporation tax without comparing it to what's currently on offer on the policy spectrum at the time. Things such as Steve talked about, full expensing, very, very generous, allowing significant amounts of offsetting of that tax, depending on the kind of activity that your business will undertake in that time. So I think, in short, no is the answer, but because I think it's more nuanced than that in the context of it depends on what schemes are concurrent and allows companies to take chunks off of that bill, and what the policy lever is trying to drive at the same time. So let's take, for example, full expensing and investment.
Brilliant, thank you, James. Eyad, we've had a question come through for yourself. So the person said, I'm confused about the subcontracting element of the new merge scheme. How is that likely to impact manufacturing companies that produce for customers or third parties?
This thing, so there's still clarification that's coming out from HMRC on this. The current kind of finance bill and kind of technical note reference the intention of R&D, right? So if company A subcontracts company B, and company A is the main subcontractor, the current rules currently put the benefit to the main subcontractor, right? So company A. However, if company A has not clearly stipulated or stated with intention that company B would be carrying out the R&D, then currently, in theory, company B may be the company that could claim. But then you have this issue of actually, well, how can I really be clear on the intention, or whether it was with company A or with company B? So there's still a bit of clarity that needs to kind of happen there. There still needs to be this a bit more detailed analysis of some of the contracts in terms of such businesses. There are business, if a business is being subcontracted by an entity that's outside the UK, or an entity that's not subject to corporate tax, then the subcontractor would be able to claim, as simple as that. But if both entities are in the UK, then the party currently given the benefit of claiming is the entity that's actually carrying out, that is asking a third party to carry out the R&D activity, or i.e. subcontracting out the R&D. The question always happens, well, what if the business wasn't even aware that the subcontractor was carrying out the R&D? How can you actually be, how can it claim? How can it know what the advanced uncertainties are? So there's still a bit of clarity to happen around that. And I would encourage businesses and companies are looking to claim to kind of really seek advice and look at the contractual relationships. In some situations, even have an open conversation with their contractor or subcontractor to kind of say, I'd like to be the party that can claim in this instance. So there's still a bit of clarity that needs to happen around this point, and this is maybe the trickiest element of the new rules.
Thank you, Eyad. And Steve, we've had one question come through for yourself. So the question is, we are considering installing solar panels on the roof of our new manufacturing building. The solar panel company we have been discussing the installation with has approached us and suggested the installation will be eligible for 100% full expensing. Is this correct?
Thanks, Bao. Yeah, that's a very interesting question, and something which has come up a number of times now, actually, in terms of rules around sort of full expensing and super deduction as well. There is some confusion on this point, but this is because although the solar panels that would be considered to be plant machinery, it is actually plant and machinery which the HMRC have a stated opinion on as being either an integral feature of the building or alternatively a long life asset, and therefore an expenditure on the solar panels would actually be treated as special rate pool, and therefore wouldn't be eligible for the 100% first year allowance, but would be available for the 50% first year allowance for expenditure on special rate pool assets, with the balance going in at 6% per annum. So yes, it does qualify for full expensing, but not the 100%, just purely the 50% first year allowance in the year of expenditure being incurred, subject to obviously meeting other relevant conditions of the full expensing rules. Thank you, Steve.
I am conscious of time, but we have got two questions. So James, I'll pose them to you, and then if we can just cover them. Thoughts on a recession in 2024?
Yeah, well, quite possible, really. And I mean, it's always the case for classes when we make forecasts that are like from 0.4 for UK GDP and indeed 0.1 for manufacturing. They're so close to the line. And it doesn't take much, depending on whose definition you want to take on the always much loved, and always makes me giggle when I hear it, a technical recession. But yes, quite plausible. But what I mean, but like similar to what was being said last quarter, not last quarter, sorry, last year, very unlikely to see deep scourges in the economy. It will remain, if we do see a recession, it'll just be a case of the line being beneath the water level, as opposed to, just beneath the water level, as opposed to just being above it. So it's largely apart from the point in terms of the implication for jobs, workers, and the general prosperity of the UK, whether it's positive 0.2 or negative 0.2, it's effectively flat. But it's eminently plausible that we'll be in that just under, we'll have that 2 quarters of technically 2 quarters of negativity that will put us in that technical recession. And no doubt when that happens, all of the front covers of your favorite newspapers will be blasted with UK in recession, it's official, sell your house, sell your children, it's all coming to an end. But I assure you it will not be coming to an end, because it's very likely to just be below the 0 line if we do get one at all.
Okay, and the final question, based on what you're hearing from your members, so across the vertical, how widely accepted is cloud computing as a strategy?
That's an interesting one, and certainly not something I'll pretend to be an expert in. We do have dedicated teams that work on so innovation in manufacturing, the policy landscape that surrounds it. It's certainly, I've certainly not heard businesses, because I engage a lot with business, but typically around their their profits, margins, business investment, that sort of thing. But I do have the privilege of hearing some stuff around innovation strategy within businesses. And I've sat in a few of these rooms where they're having those conversations. And the way that question is posed makes me think that there's some sort of potential body of critics that I'm unaware of. Because whenever I've heard the conversation about, let's say, a manufacturing company offloading its processing time onto a cloud service, which is quite common. We have some of the big players, household names, going in and working on a lot of these companies to do that. I've never heard much of a criticism as to why that would be a bad thing, apart from some rudimentary logistical challenges around questions around IP. And so who owns that IP when you're doing that cloud computing, depending on the process and product. So a little bit out of my wheelhouse, but in my experience of being in quite a few of these things over the past year, I've certainly not heard a body of criticism that would suggest that it's not accepted as a strategy.
Shall I? I'll chip in on this one as well, actually, James. Yeah, we do come across clients who have shifted to cloud computing, but it's part of a broader strategy for a business, and it kind of plays back to what should the business's operating model be, and that consists of 3 elements, which is, what are your core processes? How do your people interact with those processes, and how does technology enable those processes? And usually the question of, do I move to cloud, should be part of a broader conversation about what should our business be doing strategically, and how do we achieve that strategy? So it's one of those questions where you can't really answer it unless you have the appropriate context and understanding of within which that question is being posed. Because without having that, conceptually cloud computing is perfectly fine. The question is it appropriate for what you want to do in the future? Will it enable you to achieve your 5-10 year strategic goals by moving to a cloud platform? The answer to that maybe yes. The answer to that maybe no, and there may be some cost implications to it. Clearly, you're moving costs from potentially fixed and capitalized through to variable as well. So there's a number of things to think about, but I think the answer to that is it depends, which is quite an annoying answer to the end of an Outlook update.